Amira binti Zuhaimi. My matrix number is A23A2566. I will present nature of Padini's Holding Berhad. Padini Holdings Berhad is an Malaysian retail holding company that owns and operates fashion brands and retail stores. Padini started out in 1971 manufacturing and wholesaling ladies' garments. It has since expanded into retail operations under brands like Padini, Vinci, Mickey, and Sid. Padini operates retail store and outlets selling clothing, accessories, and lifestyle products. It primarily targets women, but also has collection for men and children. As of 2021, Padini owns 141 stores across Malaysia, market like the UAE and Myanmar through franchise partnership. Padini's vision is to be the market leader in the Malaysian retail industry. It aims to achieve this through developing credible fashion brands and exceeding customer expectation. Padini focus on expanding its regional presence and sees growth opportunities in neighboring countries.
There was analysis liquidity ratio. There are 5 types of liquidity ratio used in the Padini company, such as current ratio, quick ratio, account receivable turnover, and inventory turnover. The first one is current ratio. The current ratio of 5.3 means the company Padini could technically pay off its current liabilities 5.3 times over in year 2021. The current ratio of 3.6 means the company Padini could technically pay off its current liabilities 3.6 times over in year 2022. The current ratio of 4.5 means the company Padini could technically pay off its current liability 4.5 times over in year 2023, and overall the company Padini could technically pay off its current liability better over in year 2021 until 2023. The next is the quick ratio. The quick ratio for 2021 until 2023 are 3.92 times, 3.12 times, and 2.71 times, which is based on the information provided in Padini Financial Sheet. They show that quick ratio increased in 2022 and decreased in 2023. As a result, it shows the increase and decrease in the firm's liquidity over the past 3 years. Next is the account receivable. The account receivable for 2021 until 2023 are 7.72 times, 12.06 times, and 3.94 times, which is based on information provided in Padini Financial Sheet. This show that account receivable increased in 2022 and decreased in 2023. As a result, it shows the increase and decrease in the firm's liquidity over the past 3 years. Last but not least is account receivable turnover. Account receivable turnover for 2021 until 2023 is 0.12 times, 0.08 times, and 0.25 times, which is based on the information provided in Padini Financial Sheet. They show that account receivable turnover decreased in 2022 and increased in 2023. As a result, it shows the decrease and increase in the firm's liquidity over the past 3 years. And the last one is inventory turnover. The inventory turnover for 2021, 2022, and 2023 is 2.93 times, 5.91 times, and 2.55 times, which is based on the information provided in Padini Financial Sheet. They show that inventory turnover increased in 2022 and decreased in 2023. As a result, it shows the increase and decrease in the firm's liquidity over the past 3 years.
Good evening to Madam Anna and my fellow friends. My name is Navnitana Purupan Samikanu and my metric ID is 8232671. As group 4 for this assignment, we have chosen the Padini company. My part is capital structure ratio for this assignment, and let me talk about my part. The capital ratio is a financial metric used to assess the proportion of debt and equity that a company uses to finance and for the operates and for the growth of the company. And this ratio also helps investors and analysts understand the level of financial leverage a company employs. There are several ratios related to capital structure, including debt, debt to equity ratio, and the second one is debt ratio, the third is equity ratio, and the fourth is debt to capital ratio. For the first part, debt to equity ratio, the formula is to find the answer total debt divide the total equity. This ratio, meaning for this ratio is measures the relative proportion of shareholders' equity and debt used to finance the company's asset. A higher ratio indicates more leverage and higher financial risk. For example, as a database, 2021, for this Padini company as 0.58%, in 2022 0.67, and in 2023 0.60. For the second part, debt ratio, it can be found out when total debt divide the total asset. This ratio shows the proportion of a company's assets that are financed by debt, and higher debt ratio indicates greater level of and potential financial risk. For example, in 2021, 0.37, in 2022, 0.40, in 2023, 0.37. For the third part, it is equity ratio. It can be found out when total equity divide the total asset. This ratio indicates the proportion of a company's asset that are financed by shareholders' equity, and a higher ratio suggests a more financially stable company with less reliance on debt. In 2021, 0.62, in 2022, 0.59, in 2023, 0.36. For the last one, debt to capital ratio. It can be found out when total debt divide total equity plus with the total debt. This ratio that indicates the proportion of a company's capital structure that is comprised of debt. A higher ratio points to higher degree of leverage. For example, in 2021, 400,000 697. In 2022, 600,000 and 981. In 2023, 600,000 26,000 and 31. In my point of view, as a suggestion to improve the capital structure ratio of Padini's company can be taken by several strategic actions can to enhance the financial stability and reduce the reliance of debt. Firstly, strengthen the equity base can retain earnings of the company and also can increase the proportion of profits retained with the company rather than the distributed as dividends. This also bolsters the equity. Next action can be taken, optimize the management of accounts receivable, accounts payable and inventory to improve the cash flow, also can reduce the need of debits, and it also can strengthen the equity component of the capital structure. This firm will be able to get a more sustainable and balanced capital structure ratio by taking care of all these aspects together. As a result, the firm is better positioned for long-term success and growth for the company, and also can increase the financial stability. That's all. Thank you.
Asset Management Efficiency Ratio. Asset Management Efficiency Ratio are a group of metrics that show how a company has used or manage its assets in generating revenues. There are three formulas. First is total asset turnover, second inventory turnover, third is debt ratio. Total asset turnover, sell divide asset sale. The total asset turnover for 2021 is 0.04%, 2022 is 0.10%, and the last 2023 is 0.13%, which is based on the provided in Padini financial sheet. It shows that how the total asset turnover ratio increases annually. As a result, it shows there's an increase in the firm asset management efficiency during the last 3 years. Second is inventory turnover. Cost sale divide inventory. The inventory turnover for 2021 is 2.93%. 2022 is 5.91, and the last 2023 is 2.55, which is based on the information provided in Padini financial sheet. It shows how the inventory turnover increased in 2000 and decreased in 2023. As a result, it shows the decrease and increase in the firm's asset management efficiency the past 3 years. And the last formula is debt ratio. Formula is total liabilities divided total asset. The debt ratio for 2021 is 0.37, and we found that in 2022 and 2023 they will have the same debt ratio, which is 0.40, which is based on the information provided in Padini financial sheet. Show that the 2021 increase 2022 in the debt ratio in the same in 2023. As a result, it showed the improvement and similarity in the asset management efficiency during the past 3 years.
My name is Nordini Elena binti Khairul Izan. My normal matrix is A23A1901. Profit ratio. Profit ratio are a class of finance metrics that are used to assess a business liability to generate earnings relative to its revenue, operating cost, balance sheet, asset, or shareholders' equity over time. Use data for specific point in time. They are among the most popular metrics used in finance analysis. First, gross profit margin. Second, operating profit margin. Third, net profit margin. Fourth, operating return on asset. In 2021 and 2022, there we have the same gross profit margin, which is 0.38%, while in 2023 is increased to 0.39%, which is based on the information provided in Padini finance sheet. This shows that the gross profit margin is the same in 2022 and increased in 2023. As a result, it shows the similarity and improvement in firm profitability over the past 3 years. Operating profit margin for 2021, 2022, and 2023 is 9.25%, 17.12%, and 17.43%, which is based on the information provided in Padini finance sheet. This shows the operating profit margin increase from 2020 to 2023. As a result, it shows the increase in the firm profitability over the past 3 years. Which a base of the information provided in Padini finance sheet. This shows that the net profit margin increased from 2020 to 2023. As a result, it shows the increase in the firm profitability over the past year. That operating return on asset for 2021, 2022, and 2023 is a 0.07% and 0.50% and 0.90%, which is based on the information provided in Padini finance sheet. This shows that operating return on asset increased from 2022 and 2023. As a result, it shows the increase in the firm profitability over the past 3 years.
This part, I want to tell about market value ratio. The meaning of market value ratio is the original principal amount of the mortgage loan divided by original value. This part, we have two formulas. The first is price earning ratio. The second is market to book ratio. The first, price earning ratio. The formula, market price per share divide earning per share. Year 2021 0.88, year 2022 0.22, year 2023 0.34. As a result, it showed a decrease and increase in the firm's liquidity over the past 3 years. The second is market to book ratio. The formula, market price per share divide book value per share. Year 2021 2.30, year 2022 2.48, year 2023 2.22. As a result, it showed a decrease and increase in the firm's liquidity over the past 3 years.
Among the suggestions for improvement for company Padini is to improve liquidity management. In order to improve liquidity management, we need to increase cash reserve by maintaining a higher level of cash reserve to improve the asset test ratio. This can reduce unnecessary expense and prevent profit. Not only that, but can also diversify short-term investment by investing excess cash in short terms and liquid financial instruments to ensure funds are available when needed.
Is improvement and suggestion asset management efficiency ratio. First, improving performance and cutting expenses. Through process and strategy optimization is necessary to improve the asset management industry efficiency ratio. Second, improve sales effectiveness. This could involve training the sales team, offering better customer service, or introducing new sales channels. Can rise price. It has to be balanced with maintaining competitiveness but strategic price increases and increased revenue.
To improve and maintain company's profitability, several strategies can be taken to increase its financial stability and profit. Cost control and efficiency can maintain your attention on cost cutting and operational effectiveness notwithstanding the rise in operating profit margin to sustain or increase profitability. Evaluate and optimize operating costs on a regular basis. Next is revenue growth strategies. Use technique to boost revenue growth in order to take advantage of the trend toward positive operating profit margins. To boost operating profits, look into change to introduce new products, venture new markets, or extend your sales network. Other than that, customer relationship management. This strategy can take advantage of digital technologies to increase operational efficiency, optimize customer interaction, and streamline processes. Investing in digital transformation can increase revenue and reduce costs, which will eventually increase net profit margin.
Improvement and suggestion market value ratio. The first is product development. The point of product development is design innovation. In investing in design ahead of fashion trends, collaborate with renowned designers to generate fresh ideas. This has potential to attract new customers. The second is marketing and branding. The point is social media. Social media platform to connect with customers and showcase new product. This can increase brand value. The last, customer experience. The point is loyalty programs. Implement to loyalty program to reward customers. This can increase customer retention.
Limitation of relying solely on ratio analysis when a company performance. First, market situation. With so many domestic and foreign rivers, Padini's home market of Malaysia is saturated. Because of this, increasing market share without creative approach is challenging. Dependency on the home market. The Malaysia market accounts for a large portion of paddy revenue. The performance of the corporation may be greatly impacted by political unrest, Malaysia shift in customer behavior or economic downturns. Challenges of international expansion. Expanding into new markets internationally carries several risk factors, including miscommunication between cultures, compliance with regulation and laws, and the need for substantial marketing and logistic expenses. Fast-shifting trends in fashion. It's never easy to keep up with the rapidly evolving fashion trends. Inventory that's unsold and a decline in customer demand might rise for a failure to prepare for adapt to new trends.
In conclusion, is liquidity. Padini liquidity show mixed signal while the current ratio indicate improvement. The declining exit test ratio suggests potential struggling meeting short-term debts without selling inventory. Fluctuation in receivable and inventory turnover highlight potential inefficiencies. For profitability, the good news, Padini profitability ratio have been on a positive trend for the past 3 years. This signifies efficient resource allocation and improved business operation, leading to higher profit. There was a 5 recommendation. The first one is improve operation efficiently. Address the volatility in receivable and inventory turnover to streamline operation and free up resources. Next is grow market share. Explore the new product marketing strategy or untapped market to expand customer base. The next is exchange sales effectiveness. Train sales staff, improve customer service, or introduce new sales channel to boost sales. And the last one is strategic price adjustment. Implement price increase while maintaining competitiveness to maximize revenue.